Meantime, Credit Suisse is raising its 2019 year-end forecast for the S&P 500. The new price target calling for a gain of more than 20% for the full year, which would make that the best market we've seen since 2013. Joining us now, Clearnomics founder and CEO James Liu. James, that's aggressive. Would you agree?
It is pretty aggressive. It is in the context of the market being up about 13% already so far this year. So, let's say another 6 or 7% is what some people would be calling for. There are really two factors that matter for the broader markets right now. One is the Fed. The Fed is and has been supportive of the markets, and it looks like they'll continue to be so. Later this week, it's expected that they'll be very patient, those are their terms,
right,
and potentially pause the pace of rate hikes. On top of that, they might actually stop shrinking their balance sheet, which again will boost the market as well. So if you think about the Fed over the last 10 years, the mantra has been don't fight the Fed with the markets, and we think that'll continue.
Okay.
However, on the other side, you also have earnings, which are slowing and have certainly slowed significantly since last year. So overall, we still like the markets, but we think we need to basically have some perspective here. The market can really only support about 5 or 6% returns on an annual basis going forward. So while we still like the market, we think that we should at least have some proper expectations around the type of returns that we can actually see.
Absolutely. I think many experts would agree on the proper expectations, but I think they would also say, look, first quarter typically is, the start of the year, and seasonally it can be a little weak, but then the rest of the year picks up from there. So we've had a pretty decent first quarter. Investors feel confident here. Why couldn't we have a stellar year?
Yeah, we've had a great first quarter. Part of that, if you combine it with what we saw in the fourth quarter, is really just a bounce back from that period. And of course, we're still down from where we were at the peak of last year. So the really underlying question is just, can earnings and fundamental growth characteristics in the U.S. and also globally support the type of returns that people would want to see later on this year? And the answer is, well, not as much as we might hope. It's clear that global growth is slowing, both in Europe and also emerging markets in the rest of the world. The U.S., luckily, is still very healthy. But again, earnings growth is going to slow down. It's not to say we don't like the U.S. It just means that we need to have proper expectations around those returns.
Okay. I mean, we've seen this in the past in different parts of the cycle, and I feel like Wall Street will adjust its expectations, and they'll bring the bar down a little bit so that, earnings will be in line or will be better, and they'll be ready. I think one of the big, more key issues is that China trade deal. If the president and President Xi can come to some sort of agreement and, get that nervousness off the table, because it was that uncertainty, at least part of it, coupled with the Fed last year in the fourth quarter, that brought us that volatility. And also, the second piece, of course, would be, as you mentioned, if Jerome Powell toes the line.
That's right. There's certainly geopolitical risk out there, some of which is priced into the market, some of which isn't. So the U.S.-China trade deal, for instance, it's clear the market seems to think that eventually a deal will be reached. Obviously, there are some very specific details in there that we would want to see, but eventually something could happen. Brexit, for instance, a lot of downside is already priced into the market due to Brexit. I'm not saying there is potentially upside there, but that would be a source of surprise to the positive. And of course, the Fed, the market is pricing in the fact that the Fed will be accommodative for the market, which is why the market is as enthusiastic about the near-term prospects for the market as it is. But, again, a lot of that is certainly already priced in. Okay. So going forward, if earnings growth runs about 4, 5, 6%, we should expect somewhere in that range for market returns as well.
Breaking the market down a little bit, looking for the pockets that you think will, continue to show strength as we move forward. Do you think FANG will continue to be one of them?
So we like two areas of the market right now. One is technology and FANG. Now, obviously, it's run up quite a bit. Part of that is a bounce back from what we saw in the market lows of last year. Technology is up something like 17% as far as the S&P 500 sector so far this year. But you think about the secular growth trends in the economy, and technology is one of those stories. And part of that is driven by profitability, revenue growth, and also widening margins as well. The other area we like are consumer sectors. So that would be consumer discretionary and consumer staples. We like that because we think the consumer story is still incredibly strong right now. Consumers are doing very well in this economy. Unemployment rate is still extremely low. And retail sales, there have been some blips in that data, but overall, they've come in strong as well. So we think the consumer, which is roughly 2/3 of U.S. GDP, will continue to support both economic growth, but also those sectors also.
But your advice, even though you've identified where you think the pockets of strength will be, is also stay balanced, stay diversified. That's an important strategy, just to make sure if we hit any of those bumps in the road, any more periods like the fourth quarter last year that you can weather the storm.
That's right. It's not just staying balanced across equities. So, the U.S., we still like it, but we think there's actually more opportunity elsewhere in developed markets and emerging markets. In fact, if you think about the bounce back, we've been very focused on the U.S. so far this year. Emerging markets and developed markets, especially Europe, they've bounced back almost just as much. But also thinking about fixed income. Fixed income, again, with the Fed potentially keeping rate hikes on pause, it means rates a little bit lower, and those returns have actually helped stabilize some portfolios.
Europe has the Brexit issue. It may not go as smoothly as everybody was hoping.
Yeah, that's exactly. There is risk in those areas, but the question is how much of it is priced in. And so a lot of Brexit does seem to be priced in at this point. We're not arguing necessarily if there's a lot of upside risk there.
Right.
But Europe, if we go back to 2017, global growth was basically helping all economies around the world, including Europe. And so if we can get back to that stage where global growth picks up pace even just a little bit, we can see pretty solid returns there.
Final question. The president on a tweeting spree this weekend. We talked about one of them regarding General Motors, but so many other topics. Is he helping or hurting the market when it comes to the tweeting and the way he is unleashing on business and others?
I think the market is doing the right thing, which is trying to look through a lot of these tweets. Really, the things that matter in terms of the White House and the administration for the markets right now are, like you said, the U.S.-China trade negotiations, broadly economic policy. Where does the economy go from here? We're now in the 11th year of the market cycle, and soon we'll be in the 10th anniversary of the economic expansion. Those are the type of issues that the market really should be worried about. And so I think the market's done a pretty good job so far of basically seeing through some of that noise.
Okay, yeah, got to parse through the noise. Great to see you, James.
Thanks, Jackie.
As always. Thanks for dropping by.